Hi there, this is Tim with Cornerstone CPA. I'm the operations partner, and from time to time we do get asked this question: can you be taxed with $0 in your bank account for a service business? And we get this question in two different ways. One is, oh man, I have money in my account. Should I just spend it and so I don't get taxed on it? Because if I leave it in my account, I get taxed. Or the other way, hey, why did I get taxed? I didn't take any money out of my business. Well, for most businesses, and primarily S corps, LLCs, even with C corps, but it's a little bit different. Whether it's in your bank or not does not matter if you're going to get taxed or not. How the money got into your bank very much matters on how you're going to get taxed or not. So we're going to run a basic scenario here. We're going to follow through one service business job from start to finish, making some high-level assumptions to kind of show how this can happen. So we're going to break down one job here. First, we're going to assume a profit margin, that the business has a profit margin, which it should. And we're going to assume the profit margin is 25%. High for some industries, low for other industries. We're just going to have that as a basic assumption, make my math a little bit easier. So let's say you get a job, and let's say that job, the total cost of the job is $100,000. Okay? Therefore, your profit after you pay your crew, if you have a crew, pay for your services, pay for your equipment, pay for the materials. So the profit is going to equal $25,000. Right? So that is now what you have as the profit for the business. Let's say that, hey, you're like, hey, I don't want to get taxed on this $25,000. Let me reinvest it into the business, and so I won't get taxed on it. So let's say you take this $25,000 and you choose to buy a truck, a car, some sort of vehicle. We're doing vehicle for the depreciation schedule here. So then you buy a car for 25 grand, which then leaves, in this scenario here, for this one job, which leaves $0 in your bank account. Awesome. Few things to note here. You bought a car which is an asset according to the IRS and is therefore what's called capitalized. And capitalization is, it sounds like it'd be an awesome word, being a capitalist, capitalization, but it basically means that you cannot depreciate or you cannot expense that entire asset in 1 year. You have to space it out over what's called the depreciation schedule. So, and certain items have certain depreciation schedules, or what is common. In cars, a very common one is, I've seen 5-year and I've also seen 6-year depreciation schedules. We're going to take a 6-year depreciation schedule, which basically means, for the depreciation schedule, you have your value of the asset over time. And the IRS basically says, okay, this is going to be the depreciation schedule. So then you'll be able to expense this amount up here, and then, so, you know, this year 1, let's just say, and then we'll move this down, and then we're going to have year 2, year 3, year 4, year 5, year 6, all the way out there. So you're able to expense some in year 1, and in this scenario a lot more in year 2, which is not technically how it normally is. And then you're able to expense the difference between year 1 and year 2. So let's say in the first year it's only a couple $1,000, next year's a couple $1,000, and then you're able to then expense even more of it in year 3, and then your actual expense for those taxes will be between here and here. Those two little marks will actually be the difference between year 2 and year 3 on how much you're able to what's called depreciate that asset. With this car in this scenario, year 1 depreciation is 20%. So, we have the car, which costs $25,000, and then the depreciation for the car, which is how much we're able to expense it, which the depreciation for the car is 20%, which is $5,000 for that first year. Therefore, out of your $25,000 profit, even though you left it all left your bank account, You therefore you have a taxable amount equal to still $20,000. That's still the taxable amount you're going to be taxed on. Again, this is very high level. We're not going into other deductions, write-off, all those sort of things. The tax code is 6,000 pages long. I'm not a CPA. I'm just a partner at the accounting firm. I'm not even an accountant, but I just work in these numbers all the time and talk to CPAs and accountants every single day and see profit and losses every single day. So, therefore, your tax, assuming a 21% tax rate, which is the top 10% of the effective tax rate, therefore, your tax on this vehicle would be $4,200 or 4.2K. We'll keep it the same here with everything else. Even with $0 in your bank, you will still have that tax. And the reason why I bring this up is because a lot of people get themselves stuck in a bad position to where, they spend all their money so they don't have anything in their account, but depends on what they spend it on, the tax is still going to be coming. And then people get into cash flow issues, have to set up payment plans with the IRS. It gets kind of messy. So this is a high level view, and this doesn't matter. This is for any service business. You could be a marketing company, you could install fences, you could be doing car repair. You have a service business, and this is just a job based on a 25% profit margin. You did a $100,000 job, and if you do a $10,000 job, the numbers are just smaller. And then you invested it in an asset, in a capitalized asset, which then has a capitalization schedule or depreciation schedule. And then so you're only able to depreciate part of it. And even though your bank at this time, and again, please don't run your bank at a zero balance. Even though your bank's at zero, you still owe $4,000 in taxes in this scenario. So a couple suggestions on this. Make sure to have a good bookkeeping team. We do bookkeeping, tax, and tax planning for our clients, but have a good bookkeeping team because they will have on the profit and loss, the actual profit and loss of the operations of the business. And when you buy those assets, they will just go onto the balance sheet so that then you can actually look at your profit and loss and start planning for how much taxes you're actually going to owe. So this is Tim with Cornerstone CPA. Thank you. Have a good one. Bye.